Welcome to Vacation Rental Mastery, where your host, Karan Narang, guides you through harnessing vacation rental investments. Whether you're new to vacation rentals or expanding your portfolio, this podcast fuels your path to freedom. Join us in this movement to transform your life. Ready for change and legacy building? You're in the right place. Let's embark on this freedom journey and master vacation rental investing together.
So, hey Vincent, thank you for coming on this call, and I'm looking forward to speaking with you and spending some quality time here and trying to see how I can help you out. Can we start with a little background about yourself, please, if you don't mind?
Yeah, I'm a dentist, and I am looking to use short-term rentals to write off some active income. And it seems to be the trend for the last few years. And so I want to see if I can, use it to help me.
Yeah, so Vincent, what I'll do is, let's go through some of the questions you might have, direct questions that you might have on the call. I'll give you some of the foundations and the basics of investing in short-term rentals. And then towards the end of the call, we can spend a few minutes. I can help you understand the coaching program if you're interested. If not, no harm, no foul. I do offer coaching. I've coached about 40 people in the last 3 years. So I can talk to you about that if that's of interest. If not, I can get you some stuff to kind of get started in thinking in the right direction. Okay?
Okay, sounds good.
So a few questions for you, Vincent. I mean, when you say you're a dentist, you're a full-time dentist, and you're looking to get into short-term rentals to shelter your W-2 income, have you looked for or tried to find other ways to do that, or have you seen other opportunities, or do you think why is this one more important for you? Why do you think this is the way for it?
I don't know of any other ways to write off some active income. There might be of other ways, but I have not heard of any other ways.
Do you know of why they say you can write off active income, W-2 income with short-term rentals? Do you understand why that works?
I don't know why that works, no.
Okay, so I'm going to spend a few minutes to help you understand that, because that's an important part, and if you want to take some notes, you can be my guest.
Okay.
So the reason real estate helps people save taxes is because when you buy real estate, you get a big part, which is, you get what you call, it's a phantom loss or a paper loss called depreciation. Okay. Typically what happens is you rent out a property, you get income coming from it, you get depreciation, it helps you shelter it, so you're not paying taxes on that income and maybe a little more on the passive side. The way the IRS talks about this is anytime you have a rental property, let's say you just went and bought a single family home, okay? And you rented it out. The IRS categorizes that as a passive activity. And it can only be used, any losses in that passive activity can only be used to offset losses on the passive side. All income that you have is categorized into active and passive. So when you have a passive loss, you can only use it to write off passive income, okay? If you have an active loss, you can write off active income. If you have a passive loss, you can write off passive income, but you can't mix these two up, okay? What people do is they do what they call, so the IRS by default calls all rental activity passive. So there is no active rental activity if it is a long-term rental. Unless there are some exceptions to the rule, you can write off this depreciation or these losses if you're what they call a real estate professional. A real estate professional is a person who has spent at least 750 hours a year in a trade or business that's related to real estate, and that's basically their primary source of income. Basically, that's their job, okay? Then you can use the depreciation to write off your active income, because your active income is all through real estate, okay? So you have to qualify for real estate professional status. For short-term rentals, the IRS has a section within the law, and I'm not a tax expert, so you can definitely talk to a tax expert about it, but there's a section in the law that says that if the average duration of stay is 7 days or less, so essentially short term, then you're able to take, and if you are materially participating in it, so the average length of stay needs to be 7 days or less, and you need to materially participate in it, which means you're heavily involved, you're actually running it, you're earning that income because you're doing something, right? If you are materially participating in it, then you're able to, then that activity is classified as non-passive activity. It's no longer passive, it's non-passive, almost like a business, right? Hence, you're able to take that and write off your active income. Does that make sense?
Yes.
Now, what happens is, the Tax Cuts and Jobs Act, that was passed by Trump a few years ago, he brought in what they call accelerated depreciation, right? And accelerated depreciation basically said that as long as if you can show that a portion of the property is 5, 10, 1, 5, 10, and 15-year property, you can write off all of that in year 1, right?
What do you mean by 1, 5, and 10? What does that mean?
So think about a single family home, okay? You have a roof on the house. It does not age or depreciate in value as quickly as, let's say, the carpet in the house. The life of the carpet is 5 years. The life of the roof is 15 years or 20 years. The life of the carpet is 5 years. The windows may be something different, right? So when you look at it as a whole, as a home, the IRS says you need to use 27 and a half years. But if you do what they call a cost segregation study, which basically takes this property, an engineer comes out and he takes the property and he breaks it up into the different components of the property. And he determines and says, of this $100,000 property, this 5,000 worth of stuff is 1 year property. This 10,000 worth of stuff is 2 year or 5 year property. This 15,000 worth of stuff is 10-year property, and this 20,000 worth of stuff is 15-year property, right? So he breaks it up. Now you have a report from a qualified person that says exactly what the breakup of that $100,000 home is. So now you can go to the government and say, I actually know what the breakup is, so I'm going to take all that depreciation year 1 because that's what the law says, right? Now this was back a few years ago. In 2024, that percentage is 60%. So you can no longer write off all 1, 5, 10, and 15-year property in the first year. You can only write off 60% of the value of all 1, 5, 10, and 15-year property. You see what I'm saying? So if the property is about $100,000, about 25,000 of it is probably 1, 5, 10, and 15-year property. Okay, the land has no depreciation. So that of that 100,000 that's there, let's say the land is 10,000. Okay, you take that out. Now you got 90,000. Another 25 to 30% is probably 1, 5, 10, and 15. Now that's only the engineer can tell you that, and when they come and do the study, right? In 2024, you can take 60% of that and write it off against your active income. But the criteria that comes up for that is you need to materially participate in that activity, which means you need to self-manage the property. Make sense?
So is that 60% off the 90?
60% of the 25. Now the numbers sound small, but let's say it's $1 million property. Okay. For ease of calculation, we do it as 1.2 million. 200,000 is land, and the building structure is $1 million. Of that $1 million, between 25, something in the 25% range is usually 1, 5, 10, and 15-year property. Could be 20, could be 30, right? If it's a condo, it's higher. If it is not, whatever, it varies. The engineer tells us what percentage that is. Now you take that 250,000, that is 1, 5, 10, and 15-year property, apply 60% to it, which is 150,000, and that's what you'll be able to write off against your W-2 income. Make sense?
Mm-hmm.
So this is why you're able to offset your W-2 income with the big loss from short-term rentals to save taxes. Now,
Okay.
I'm going to give you a little piece of advice, right? Don't buy a bad deal, don't buy a bad property, don't get into this if the only objective is to save taxes. Okay? You're not going to spend $1 to save 40 cents, correct?
Yep.
Same
That's
thing. So
correct.
we're not going to do that. And this is where I help all my clients understand, because 9 out of 10 clients come to me saying, I want to buy a property because I want to save taxes. No. You know what? That helps. That pushes you to make a bad decision. We're not making bad decisions here. The property needs to be bought at the right price where you're not overpaying for it. It needs to cash flow positive significantly because it is a short-term rental, right? We don't want to invest in something that does not cash flow well.
What is considered significant cash flow?
Good cash flow in this market, not significant. Significant to me is in this market is still 20+% cash on cash return. Higher the better, of course. But good cash flow in this market is still probably between 10 and 15% return because you have interest rates that are in that 8% range. Okay. I would even go as far as to say that in today's market, you can play with it. Somewhere between 10 and 15% is still possible. And a lot of long-term rentals and a lot of multi-family rentals can't get that today because of the interest rates. Very, very difficult to cash flow on any of those asset classes unless you get really creative or go to like a Class C property. So short-term rentals still have decent cash flow, right? Now, do you already have some real estate?
I do. I have a long-term rental that I'm thinking about turning into a short-term rental.
What's stopping you?
When I think turning it into the short-term rental, I would only make maybe 10,000 more per year, which in my opinion is not really worth it.
Return on time, right, is not worth it for you. Now, why would you even consider doing it? Is it not cash flowing right now?
It's cash flowing right now, but
Okay.
if I could also get the active write-off, then it might be worth it because I already
So,
own the property. I'm not buying a property to turn it into a short-term rental.
how long since you own that property?
About 4 years.
So talk to your CPA because the accelerated depreciation requires a change in the tax method that you're going to use for depreciation. You're not going to gain much from it. It's already been in service for 4 years. You've already taken some depreciation on it. So it's probably the juice is not worth the squeeze, I think. But check with your CPA for sure on that. Okay.
Okay.
And typically you want to take that write-off in the year in which you place it in service.
So if I place it in service this year, but I've owned it for 4 years, it still might not be worth it.
It's already been placed in service because it was a long-term rental.
Got it. Okay.
So that's where the challenge comes in. So again, talk to your CPA as to how it's going to be beneficial. My understanding is it's not.
Yeah, I don't think it would be beneficial from
Correct. Correct. So
and it's not beneficial because the juice has been squeezed.
You already gotten some depreciation out of it. You're already doing that stuff. I just don't think it's going to benefit you much. Plus, I don't know if I've heard of anyone going back 4 years. You have to change your depreciation method and stuff like that. It's just not worth it unless it's your CPA might tell you differently. So please check there.
Okay, so what's the cutoff? 1 or 2 years? That's when it's still worth it. Usually,
Typically, it's in the first year that people do it. At most, the second year. I don't know if there's a hardcore, like a real cutoff when it needs to be done. But I usually don't hear anyone doing it in beyond year 2.
Does the appreciation in value affect it? Like, let's say it appreciated, 50% within those 4 years. Does that make it more worth doing, just general wise, without consulting with the CPA for specifics?
No, and I tell you this because the depreciation is not based on market value. It's based on your investment into it, your cost basis. What's your basis in the investment? So And I get this question a lot with people saying, I'm sitting on this property that's a long-term rental or a short-term rental, and I have,
Yeah.
so much more equity in it and all this stuff. There's only a couple ways to get away with it. Either you're going to sell the property to pull out the equity and invest in something new and get the tax break, or you're going to essentially do a cash out refi to tap into the equity and use that money to invest somewhere else and get the tax break. But an existing property converting from long term to short term, I tried to do this a few years ago, to be honest with you, with the property that I had, and it just didn't make sense. I ended up selling it and doing a 1031 exchange.
Okay.
So
Great. Thank you.
No worries. So tell me this: what is your goal? I know that sheltering taxes, but do you have another, like a desire to own short-term rentals?
My goal is to have a little bit more income where it doesn't require as much as my time, because me being dentist, I have to go into the office to work to make income. It would be good to have some more, less active income than, being in the dental office.
So let me put it this way. What I'm hearing you say is that your dental office is a lot of active work. You're trading your time for money, and you prefer not to have to do that the same way for a rental property. You want it to be as hands-off as possible. I get
Correct.
that. So what if I said that it is possible for you, especially, and this is a strategy that I work with on a lot of clients, right? They come in with the same thing, saying, I have no interest. Yes, I have no interest. I want to buy the property. I want a good cash flowing property and an asset that is going to appreciate in the long term. I want good cash flow from it. I want to be able to take the write-off in the year one, but I have no desire to manage it on a long-term basis and start a hospitality business.
Right.
Okay?
Because I love what I do. I love doing dentistry.
Yep.
I'm not going to give that up, but it would be good to have, some other passive sources of income.
90% of my clients are exactly like you. So what we typically do, and I'll explain this process to you, is we will help them acquire a property sometime by the third quarter. Okay? Let's say you close on a property in September. In October, you're spending the month getting the property up and running, and depending on the location, could be low season or whatever, right? You manage the property in the year it is placed in service, which is when you get the tax break, and we take over and manage it for you starting January 1st. So you no longer need to be actively involved. You got a property that cash flows well. The underwriting already takes into consideration that you're paying us to manage it for you, and starting January 1st, you don't have to manage it. But if you do
What's
want
the
that,
purpose of buying it later in the year? Is it because you have to manage it for a certain number of time, or you have to
yes.
manage it for the year that you own it? What's the difference between buying it in January versus buying it in November?
So there's a few different criteria you have to meet in order to say you materially participated in managing that property. Okay? If you buy it now, and again, there is, basically the long and short of it is that nobody else can do more work on the property than you can. Okay? For this year. If you buy it today and close on it now, you're going to be actively managing it for the rest of the year. You can't give it out to someone else to manage. If you buy it towards the end of the year, you got a couple months, you manage through it, and then January 1st, you're done. So that's the big difference between, and basically there's a lot of intricacies around it, but essentially what they say is you have to manage it. You should be the guy who's running the show. You can have cleaners and handymen and all that stuff. That's all okay. But you should be the person running the show. You need to be materially participating in that process of generating that income and taking that loss.
Okay.
So that's why if you time it in a manner, which is not necessarily bad, because we're in January right now. Let's say you give it a couple months and you start searching. In today's market, we are not putting in any offers at asking price. It'll take us a couple of months to figure out what market you want to go into. Are you tied to particular markets? You want it close to home? Don't care. Want the maximum return? Any thoughts around that?
Right, just the maximum return.
Okay, so then you're pretty much open to the entire country, right? And it'll take us, a few weeks to figure out exactly what market is best for your investment and your investment style and where you should invest based on your budget and the expected return. We then get started with the search process of trying to find a property that meets the criteria. Then we jointly do the underwriting, because estimating the revenue and the potential revenue is a critical part of the equation. We do the underwriting, taking into consideration all the different costs and everything that go along with it, to arrive at what we call the cash on cash return.
Mm-hmm.
Let's say it's the same $1 million property and you put $200,000 down payment. We need to really figure out, after all expenses and after debt service, how much money are you actually getting in the bank every month or every year, right? So estimating that cash on cash return is a big deal. So being able to make sure that you accurately identify how much money you're going to make before you go put in that offer and lock up that property and go buy it, because you need to be an educated buyer. You can't just walk in and say, I'm going to buy this place, and what's the market, because the property may be priced right, maybe priced lower than market, but if that area does not have the rent potential that we need to make it cash flow well, you're going to lose money. An asset that does not cash flow positive is a liability. It's going to pick your pocket every month. You don't want that, right? So the idea is, we're going to spend the time, right? Take 6 months. There's no rush to buy a property. Unless, you have something else driving it, that's different. There's no rush to buy it. Let's buy it right, buy it under market if we can. Let's get the financing on it, close on it, and put it in service. That should be a goal for the year, and say, okay, let's go do this. Unless you're willing to manage it.
Yeah, people are telling me that with short-term rental, that time period to invest in short-term rental is getting harder and harder, because Airbnb the fees are expensive, VRBO fees are getting expensive. People are more willing to stay in hotels now. And so because of all these high fees and everything, that it's just really, really hard to get that, 10 to 20% cash on cash.
The fees are high. They've always been high. They've never been, they've been maybe a little lower, but they've always been high. Nobody wants to spend an extra 20% on a place just because Airbnb wants to charge them a fee. Okay. The idea is, how do you create maximum value for that guest? Why should they come stay with you? That's where the whole game comes into play. If you could just buy a property and put it on Airbnb and make money, that'd be great. Why not? So, in my opinion, when you actually start looking at the equation, that's why we come down to the numbers. We look at the cash on cash, and in that we even have platform fees built in. So we say it's 3%. For example, Airbnb charges us. We build that into our calculation and make sure we know the cash on cash return accurately. Okay. Now, as far as this things are getting harder and harder, don't let the sense of urgency lead you to making a mistake. There's no rush. Okay. Take your time.
It's actually leading me to the opposite, leading me to not want to do it, because
hey, no investment is risk-free. It's going to happen. The most important thing is, how do you make sure you don't lose the money, right? How do you make sure you make a good investment and you protect your investment in it while it's making money? All I do is short-term rentals. So as far, short-term and mid-term, but essentially the same thing, furnished rentals, right? And yeah, it's gotten harder. It's trickier. There's more supply in the market. The market is a little slower, but that's why you need to actively manage. I can put you in touch with a couple of people that we manage for, and they'll tell you we outperform the market pretty well. So it's not impossible. It's totally doable, especially if you're starting with identifying and buying a property for the purpose. If you buy the right property at the right price and put in place the right processes, I don't see why it wouldn't cash flow really well. If all you care about is 10 to 15%, fine, all day long. 10% is all day long.
Yeah, I would like more than
Yeah,
10,
we
15.
all would, man. And I'll tell you what it is.
Yeah.
The whole philosophy is if you can get it to cash flow 10 to 15% at 8% interest rate, and in 3 years, when interest rates drop and all these people get into the market because they're sitting on the sidelines right now, they get back into the market at 6%, demand's going to go up, comp values are going to go up. You would be in a position to go do a cash out refi and pull your investment out. That's the whole philosophy I'm working on. I'm buying properties now because I know if I can hold on to it for 2 or 3 years, I'll be able to get most of my bases out again. It's a risky play, but again, nothing is risk free. If you want risk free, you have to put the money in a some sort of an investment and make 6 to 8% and have no tax break, which is that's fine. It's tricky.
Okay.
I get it. It's complicated. It's tricky, but it's certainly doable even today. I mean, I've had 4 calls just today, and it's certainly doable.
Okay. Sounds good.
So what other thoughts? I feel like there's something in your head that's going that's
Yeah. How
saying,
much do you charge? How does that work? What are your charges and fees and all that stuff?
well, we charge 7,500 is what I charge, and it starts from getting you from here, from this point forward, um, identifying the location, identifying the property, helping you close on the property, and getting it up and running and everything else. And you by no means have to hire me. You can do all of this yourself. And if you say, hey, I'm gonna go do this myself, I'll give you all the I'll give you all the resources. I don't have a problem with that, right? Don't take this call to be a sales pitch. This call is for me to answer any questions you have and anything I can do to help you progress if this is something that you want to do strategically.
Yeah, I would definitely like more information, so I can do my due diligence to see if this works for me for sure.
Yeah, for sure. And again, I'm happy to. You're welcome to join the coaching and all this stuff. That's all great. But like I said, none of this is rocket science. The only difference is, if you do join something like that, then it helps you expedite. It helps you move things forward without having to go research and figure out everything else. And yeah, I'll give you the information.
And then what do you guys do for management fees?
So our ongoing management fees are 15% of revenue. We typically earn our keep. We typically will outperform the market and we'll do at least, something, 8 to 10%, maybe 15% better than the market. So we'll typically earn our keep.
Okay. Are there any, I guess, how many short-term rentals do you own? How many do you actively manage? And then are there areas that you're not in yet?
Yes, so we own 9 short-term rentals. We manage, I want to say it's 18, maybe 19 right now for others. And we are not in a lot of places, but we are able to manage anywhere because it's a hybrid model. We're managing, we do all the virtual stuff. Our VAs handle all the guest communication. Every time they send a message, I can't get in, my VAs are answering all that stuff. We do all the communication, we do all the marketing. So if you go to like Facebook and look at Adventure Awaits Stays, you'll see our Facebook page. We do all the marketing, we do email marketing campaigns. Our direct booking rate is about 20%. And it's growing steadily as time goes. And basically, we partner with a local cleaning company and handyman and all that stuff and try to keep the property maintained and cleaned and all that stuff. So again, it is a hybrid model. Most on-site property managers charge between 20 and 30%. But because we're doing this all virtually and coordinating locally with the cleaners and cleaners and handymen, we're able to offer it at 15%.
Okay, awesome. Yeah,
Any
you
other
can send
questions
me
for me?
whatever you want to send me, and then I can take a look at it, and then we can certainly go from there. But I do
Sure.
appreciate the chat today. So thank you.
Yeah, sounds good, man. Feel free to reach out if there's anything else at all I can do for you. Like I said, I'll send you some information about what we have to offer on the coaching and the co-hosting and all that. And if you have questions, again, any question you have, you start looking at properties, you want to estimate what the revenue is, whatever, just reach out. You know where to find me. just reach out and I'll help you wherever you need.
How accurate is air DNA and things like that?
That is a trick question, my friend. And the reason I say that is because I have never found it to be accurate. And I was just having a conversation about this with a lender yesterday. So they look at air DNA for short-term rentals, and it does not come close to what the property does. I mean, in some cases, like, we have a property that does, I don't know, 30% better than what air DNA says. That's a big difference. So
Yeah.
it depends a lot. And honestly, I'm not sure how they come up with those numbers. And they have obviously some metrics, and they're scraping the internet for data and all that stuff. I say you need to use that as indicators. Unlike long-term rentals, where you can go look up what's a prevailing rental rate, you can look at Rentometer or something like that, and you can come up with within $50, you'll know, hey, the rent is either $1,500 or it's $1,600, right? In short-term rental, you can have two properties right next to each other performing 25% differently, right? May even look the same, but it's all about the experience you're going to create for the guests. If you create the right experience, have the right reviews, have the right pictures, right decor, right location, it'll beat the next guy over. So that's where short-term rentals is a lot more of an art than long-term rentals. So it takes a little more creativity to really maximize on the potential of a short-term rental.
And so how do you calculate what the rent's going to be or what the short-term rental rates are? Because if there's no place that really says it, then how do you know how well it's going to do?
So when we underwrite these deals, we actually look at multiple sources. We look at the past performance. If you're buying an existing short-term rental, we look at the past performance as an indicator. We look at, we reach out to local property managers to find out what they're estimating the property will make. We'll never use them because, we manage it anyways, but we still get an idea from them. We'll look at air DNA, which gives us a third metric to go in. We will then go look at Airbnb and look at listings in that same neighborhood or close by or whatever by looking at the map and trying to figure out which ones are close. And we'll basically collect all of this and we'll look at the numbers. On top of it, we'll add in what we know to be, our ability to accelerate, to grow that revenue even further. And we know in our past performance, we've seen how we have outperformed. So we know, hey, typically we can do 15 to 20% better than the market, better than what we are seeing online, right? So I'm happy to put that in because I know I can do that. So that's how we kind of look at all these different factors and come up with what the revenue looks like. But that's only one part of it. We then take all the information we can get on the costs, because you got to figure out the insurance is going to be different depending on where you buy. Even within a city, the insurance is going to be different. So we estimate insurance costs, property taxes. These are the two big ones that'll hit you that you may not even pay attention to. We talk to cleaning companies. If you're already in the market, we know what the cleaning company charges. If not, we go figure it out. We look at the taxes. So we're trying to put all of this together and come up with a pro forma as to what we think the net operating income of the property is going to be after everything is done, after all expenses. Then we deduct the mortgage payment. That gives us the cash return on the property. Okay, and now we can calculate a cash on cash return. So this whole process of underwriting the property to make sure you don't make a mistake, right? That's absolutely critical. So this is where you need to be able to go find all these different data points, put it in your spreadsheet and come up with that number and say, okay, I'm very comfortable thinking or knowing that I'm going to make 20 grand a year or whatever it is, 20 or 30 or 50. You need to be fairly certain, right? Then what I often tell my clients is you don't stop there. Once you buy the property, you continue to measure those KPIs. You still come back and look at those numbers and say, how far off was I? You might have been far off, you were not far off, you were close, you could adjust up or down, and continue to monitor it. If your insurance price all of a sudden shot up, guess what? Your cash on cash return just went down, right? what was a good investment a year ago may not be a good investment today, and maybe it's doing good in the market and you can sell it. So things like that, that's the active management part of it that is absolutely critical to build this business.
Okay. Sounds good.
Awesome. Well, thanks, man. If there's any other questions, reach out. If you know where to find me, I'm happy to help where you need help and meet you where you're at, okay?
Okay. Thanks, Aaron. I
Awesome.
appreciate it.
Thanks, man. Take
Okay.
care.
All right. Take care. All right. Bye.
Thank you for joining us on Vacation Rental Mastery. Don't forget to subscribe and tune in for our next episode, where the journey to financial freedom and lifestyle flexibility continues. Here's to your success in the exciting world of vacation rentals.